Mode.
Good afternoon. My name is Luis Pereira. I'm with Minnesota Housing and specifically with the Single Family Community Development Division or group. You've joined us for Address Gaps in Your Community, Leveraging Multiple Home Improvement Programs. Our attended audience today includes nonprofit organizations that work on housing, CAP agencies, housing and redevelopment authorities, community development agencies, EDAs, and community-minded lenders and credit unions. When we last looked at the registration list, we had a pretty good mix of those groups, about 28% city-county HRA organizations, 29% nonprofits, about 23% state agencies or other co-funder partners, and about 12% banks or private sector lender partners. So we had a total of about 140 people on this call. So a quick logistical point here. We have a statewide tornado drill today. And this is to practice your organization's sheltering plan. So you might hear some external warning sirens at 1:45. We've been told to remain in the building in a secure area away from the perimeter where there are no windows or external doors. Safe areas include interior corridors and hallways, stairwells, and any room that is windowless. A basic guideline is that if you can see daylight from where you are not safe. Please note that we will continue with the webinar during this drill, as we are located in a small windowless tornado-proof room. And to get a sense of how many people will be observing the drill, if you'd like to let us know in your chat box if you'll be leaving your workstation temporarily. All right, so here's our agenda. So to define the problem, home improvement gaps and barriers in your community. We're going to do a walkthrough, sort of a program overview, both of competitive programs available via request for proposal process, as well as lender-driven programs. Then we'll walk through 4 community scenarios, and then we'll take your questions towards the end. So with us today presenting, we've got Robin Bipes, who's the Director of Programs and Lending for the Greater Minnesota Housing Fund, Chrissy Hoffman with the Single Family Property Preservation Team of Minnesota Housing, and on the phone we have Claire Vandereyck, who's the fairly new Fix Up program manager, also on Chrissy's team. Also in the Minnesota Housing Studio we have Nancy Slatzfeen and Nick Betcher from the Impact Fund. We have Jenny Rydberg and Stephanie Vergine from the Single Family Direct Rural Development USDA. And we have Jeremy LaCroix from DEED Small Cities Development Program. So this is how we might conceive of a desired end state, that there is a spectrum of home improvement programs in my community serving borrowers across a range of situations. So that would be a variety of incomes, credit scores, affordability situations. So can the borrower afford a monthly payment or not? And if so, is it amortizing, is it deferred, or is it grant or a forgivable deferred loan? And then that there also are different options as it relates to the loan being secured or unsecured. So the issue, you may know that there are very real service gaps, but perhaps also perceived gaps in available owner-occupied rehab programs, as well as barriers faced by individuals or groups of borrowers in accessing these programs. For example, we have both household-specific and program-specific gaps and barriers. You may find that a household does not qualify due to their income being above the program income limit. or the household's credit score is below the minimum required by the program. Again, the household may not be able to afford a monthly loan payment because they have a large monthly mortgage payment and or installment or revolving debt to pay every month. And another barrier may be that the household has low or no equity in the home, meaning they may not be able to access a secured loan. Another source of barriers or gaps relates specifically to the program, including geographic limitations to certain programs, as well as requirements that relate to lead risk reduction. And so the cost of those items tend to eat up your project budget and your loan amount, so other improvements cannot be made. We thought we might talk a little bit about various approaches to offering home improvement programs. So these are a few that we came up with. The laissez-faire, or you're on your own approach, where you refer borrowers to other program providers that offer a complementary program in your area. So it might just be you're giving them the phone number and the address of another program provider. We've also have the approach of where you have a partnership among various program providers. This is where one agency works explicitly with another program or service provider on behalf of the borrower using your program. So you may be sharing information about the borrower and their proposed rehab project, the scope, maybe an inspector, to layer the different program funds in the same project. Then there's the approach that we call all-in-house, where one agency is providing a spectrum of home improvement programs serving a variety of needs, and you might layer various program funds in the same rehab project. There may be other models out there as well, so we'd be happy to talk more about that later. I'm going to pass it off to Jeremy.
Good afternoon, everyone. So what you're seeing on your screen is who's being served and where throughout Minnesota by rehab programs. You'll see that the Deed Small Cities program and the Fixed Secured program have good coverage statewide. They are the pink and the clear dots. Clear dots are a little difficult to see, but they're out there. The Impact Fund, GMHF, and the Community Fix-Up Fund, you'll see, are kind of clustered around the regional centers, and they're administrator-driven, blue, red, and brown dots. The USDA, you'll see, has more dots in the central and western part of Minnesota, plus in rural areas. They have smaller loan sizes and grants. You'll see the Fix-Up Fund, which is orange, is emphasized and more often in the Twin Cities metro area and the south central part of the state. So our program's in a nutshell. We're assuming that you know something about the Impact Fund, GMHF, Deed Small Cities, the Fix-Up Fund, and the Community Fix-Up Fund, as well as USDA RD programs. But here's a quick review of the programs. So all of the programs are available on a competitive request for proposals. You'll see the first column there is the Small Cities Development Program, which is available to cities under 50,000 and counties under 200,000. We call those non-entitlement areas. The larger cities, if you're in Mankato, Rochester, Twin Cities, Duluth, St. Cloud, receive their funds directly from the federal government. We have an annual RFP. Proposals are due in November. Application is due in February. For rehab loans, it has a 0% interest. The local communities set up their own terms. Most often it's a 7 to 10 year forgivable loan. Minnesota Housing Impact Fund is statewide. They have an annual RFP in June, 0% interest, and their terms are a 30-year deferred loan. And the Greater Minnesota Housing Fund provides their funding outside of the Twin Cities 7-county metro area. They are also in the annual RFP in June, and they also have 0% interest and a 30-year deferred loan. So for the Small Cities Development Program, in order to do owner-occupied housing rehab, the homeowners need to be under 80% of county median income. And again, we provide grants to cities outside of entitlement areas, under 50,000 or under 200,000 for counties. Generally, the limit is 25,000 per home, and generally most of the cities select a term that is 7 to 10 years forgivable. We do provide our administrators up to 15% administration fee. Some of the drawbacks, larger communities are not eligible, and there are some federal requirements, but the program has generally pretty good terms for homeowners. And I'll hand it back over to Luis.
Great. So this is the program I mostly work on, the Impact Fund, the Community Homeownership Impact Fund. So this is based on the Economic Development and Housing Challenge Fund, which is a state appropriations through the legislature. We can serve home buyers or homeowners earning up to 115% of the area median income. It's defined separately for the Twin Cities metro, 11-county metro area, as well as for Rochester. And then there's a separate income limit for the balance of the state. Typically, owner-occupied rehab is via a 30-year deferred loan that is repayable, 0% interest. We also provide limited grant funds to discount the interest rate of a community fix-up loan to increase the affordability of the monthly payment. Chrissy will talk a little bit about that momentarily. We provide up to a $500 fee per unit for the administrator to participate. A few drawbacks are impact fund dollars are scarce, competitive, and not guaranteed via the annual RFP. To be competitive for impact fund dollars, we require an owner-occupied rehab program to serve a special niche. So you must show how you're making use of existing available programs in your area to address community needs, both the ones that we're going to discuss in this presentation as well as local programs if there are any. We really like you to leverage those programs as much as possible because, again, the impact fund dollars are scarce and they have alternative uses. So it's sort of a precious resource we have in the state to fund a value gap for development projects, whether it's new construction or acquisition, rehab, and resale of vacant units in your community. We also work with and support our co-funder partner agencies, some of which are here with us, and are aware that they have programs that have very favorable terms as well, so we like to promote that. I'm going to hand it over quickly to Robin from the...
Hello everyone, just a few quick notes on the slide for Greater Minnesota Housing Fund's owner-occupied rehab funds. As Luis mentioned earlier, Greater Minnesota Housing Fund primarily provides our owner-occupied rehab funding in partnership with Minnesota Housing through the annual Impact Fund. That annual Impact Fund this year, the application date is June 16th. So just note that if you would like to apply for the Impact Fund for GMHF funds, that would have to be done by June 16th of this year. The characteristics of GMHF's owner-occupied rehab financing is that we actually meet or allow household income to be up to 80% of the greater of the statewide median income or the area median income. And if you have any questions about those income limits, those are available both on the GMHF website and on the Minnesota Housing Impact Fund website. So 80% of area or statewide median income. Our funding is exclusively available for administrators and home buyers and homeowners outside of the 7-county Twin Cities metro area. We have a limit of $8,500 per family or per household, And we structure our financing as a loan that is up to a 30-year term. So 0% interest, up to 30-year, deferred, no payment, no payments made until the end of the loan. We do provide incentives for administrators to administer our funds. This is $300 fee per unit for the administrator, and that's if no other administrators are willing to pay for that fee. So if you have a pot of funds where no other funder is allowing you an administrator fee, we do allow $300 per household. And just a few notes, there are a few drawbacks to our funding. First and foremost, scarce resources. We only provide financing through the RFP, through the Impact Fund. It's competitive. You're not always guaranteed our funding, but we do try to make sure that we serve the entire balance of the state. I would also say, just note that ours are really structured as loans, and these must be repaid by the homeowner. We're flexible on how to do that when it comes time to repay, but these are not grants. We are one of the funders that does not provide this as either forgivable or as grants. And I'll just add a few other quick side notes. Greater Merced Housing Fund and the other funders are available to provide technical assistance if you have follow-up questions on how to figure out the layering of our funds with other funds. You can contact us at any time, and if you also have questions about a potential application you're going to be putting into the June 16th Impact Fund, we're happy to answer questions. And then new this year, GMHF also is a member of the Federal Home Loan Bank of Des Moines, which means that we are able to sponsor your application if anyone is applying for additional funding assistance to the Federal Home Loan Bank of Des Moines for single-family projects. So again, happy to help you with that. And I will hand it back to Minnesota House.
All right. Hello, everyone. This is Christy from Minnesota Housing. So Jeremy, Robin, and Luis just discussed the competitive programs available through RFPs. So even if you are or you aren't awarded funds via Impact, GMHF, or Small Cities via the annual RFP, are you fully utilizing other funders' programs? Are you using Minnesota Housing's Fix-Up Loan, or do you have a Community Fix-Up Loan initiative established? Or are you using USDA's RD Section 504 grants and loans? Minnesota Housing's Fix-Up Loan program, we utilize a statewide network of lenders to deliver our loan product. When you compare the Fix-Up Loan program to traditional loan products, we offer a lot of flexibility so the homeowners are able to choose their own improvements. We have higher loan-to-value limits, up to 110% of the after-improved value unsecured loan options. We have affordable fixed rate, a fixed interest rate for the full loan term, which can be up to 20 years depending on the loan amount. And we also have unsecured options for borrowers with no equity or limited equity. There's also no income limits for select energy and accessibility improvements. We do pay each of our administrators or lenders for the loans that they produce under the Fix-Up Loan program. Our lenders get $400 for each secured loan and $250 for each unsecured loan. A 1% origination fee can be charged on secured loans, and a $50 administration fee can be charged on those loans as well. Some of the drawbacks of the program or the limitations is that it does require a minimum of a 620 credit score on a secured transaction or a 680 for an unsecured loan transaction. And it does have a monthly payment, which might not be affordable to all borrowers and may not work with their budgets. So using the same program guidelines as the Fix-Up Loan program, the Community Fix-Up Loan option has, or loan program has the option for a lender or a local nonprofit to write down the interest rate and make the monthly payments more affordable, or they can include a value-added service such as an inspection service to the loan. To illustrate this process, an application is submitted addressing your specific community needs and identifying the partners included in the initiative. That application is given to Minnesota Housing for review and then presented to our board for approval. And after it's approved, the lender markets, originates, underwrites, and closes the loan. Those funds are available for 2 years, and the local dollars or impact fund dollars is what's used to write down the interest rate. All right, and I will hand it over to Jenny from Rural Development. Thank you.
you. Thank you, Chrissy. I'll be explaining the Single Family Housing Direct Home Repair Loan and Grant Program, which is the Section 504 Rehab Program. This program is eligible to rural residents in cities with a population less than 20,000. The maximum grant is, the maximum assistance is $27,500. The maximum loan can be up to $20,000 to repair, improve, or modernize the homes. The loan term is up to 20 years with a 1% interest rate. There's a lifetime grant of $7,500 for elderly homeowners that are 62 years of age or older and that do not have repayment ability of a loan. Grant funds are used to remove health and safety hazards. The income limit for both programs is 50% of the adjusted median income. We can do a combination of a loan and grant totaling up to $27,500. Here are some more characteristics of the Section 504 program. So what does a good partnership look like with rural development? There are 12 regional offices. Those offices include our northeast section of the state, our Virginia office, Baxter office, and Bemidji. Our northwest area, which include Thief River, Falls, Alexandria, and Detroit Lakes. Our southwest area, which is Wilmer, Worthington, and Marshall. Our southeast section, which is Faribault and Austin, and our east central area, which is our Cambridge office. There are a couple of drawbacks. Loans over $7,500 do require a real estate mortgage or a lien on the property. And then, unfortunately, cities with a population greater than 20,000 they're ineligible. What is the incentive for an administrator to partner with rural development? Partnering with USDA with the USDA programs allows you to stretch out your resources in other programs, help more homeowners in your communities, and address the full project costs and needs. Why combine programs? Again, beyond the direct financial incentive to you, why combine the programs if it means more work for you or coordination with partners or partner organizations? The annual competitive RFP processes all required leveraged funds. Using less funds per household under each program allows you to reach more households. Providing a spectrum of homeownership resources in your community, either all in one house or with other partners, offers you flexibility to mix and match and better respond to diverse needs. We wanted to give you some community scenarios with an identified gap or need at the household level and provide a potential way to address the identified need using more than one program. These solutions or combination of programs represent only one way to address the issue. There are many other combinations as well. We'll look at scenario 1. This is a senior couple that lives in Crookston. They are very low income and have almost paid off their first mortgage. They also have a lot of deferred maintenance. Crookston has a population of 7,964, so it is under our 20,000 limit and is in an eligible area for USDA rural development funds. The project cost is quite large, totaling $40,000. The couple would like to invest to make it easier possibly to sell in the future or keep it livable, to be occupied by them or possibly their kids in the future. The household age is 62, so they are eligible for a grant up to $7,500. It is common for the grant funds, if they're eligible for a grant, to combine with a loan similar or exceeding the $7,500. In this scenario, we are looking at a $12,000 rural development loan and the maximum $7,500 grant. The maximum loan is at 20 years. It is allowable that they pay off this loan before maturity. The grant has no repayment as long as they remain in the house for at least 3 years. A deed small cities loan is possible here, typically at a term of 7 to 10 years. As long as they continue to reside in the home for a term of the loan, it is progressively forgiven over time. Finally, the Greater Minnesota Housing Fund 30-year deferred loan of $5,000 is set to address the remaining project costs. While deferred for 30 years, households can choose to make payments at no penalty. The result is a very affordable payment on the Section 504 loan, a mere $55 per month, and we are addressing the full project costs of $40,000. A local administrator in Northwest Minnesota that we might highlight is Northwest Minnesota Multi-County HRA, which has used Deed Small Cities and USDA Rural Development Section 504 program via the Thief River Regional Office. They have had projects including windows, lead-based paint costs, doors, and roofs. Now I'll hand it over to Jeremy.
Thank you. So I will be providing you with scenario number 2. I hope everybody made it safely through the tornado drill. You'll see in this scenario, it has a family that lives in Faribault. They're under 80% of the area and county median income. They have somewhat high non-housing debt. Faribault is a non-entitlement area, and under this scenario they have a Deed Small Cities grant. The house needs a new roof, a new water heater for a total project cost of $20,000. The family has 0 equity, which means that the current amount owned on their mortgage is equal to the current home value. Just a side note that underwater homes have dramatically went down in the last couple of years from 18.4% in 2011 to 7.2% now. Also of note, when I think underwater, the Deed Small Cities program cannot be used in a flood zone. You'll see a little bit here more about scenario 2. Because the family is under 80% of median income, they can use the Deed Small Cities program, which would be a deferred loan, most likely from the city, of $17,000. If you recall that the city has a high non-housing debt, but they have a decent credit score, in this case 680. An unsecured fix-up loan requires a 680 score, so they are eligible. They fill in the remaining project gap with an unsecured fix-up loan of $3,000. The fix-up loan carries an interest rate of 6.99%. However, with an automatic payment, they qualify for a minor rate reduction to 6.49%, which saves them about 75 cents per month or $9 a year. An alternative to this program mix would be to address the greater share of the project costs with a fix-up loan in order to spread limited deed funds across more households. I'll just note that in most cases, deed will not pay for 100% of the rehab, so it is good to have these other programs to assist the homeowner with covering their portion of the costs. An example of this you can see is SEMCAC in Rushford. They're the local administrator in southeast Minnesota. They currently have a grant in the city of Austin where they are pairing up small cities program loans and fix-up fund loans. And I will hand it back to Luis for scenario.
All right, so scenario number 3, we have a family that lives in Cloquet. They bought their home a few years back. The home is large, given their plans to grow their family. However, the home is an energy hog, so the heating bill is very big in the winter. Cloquet has a population of 12,180, meaning it's both small cities, development program, and USDA RD eligible. But unfortunately in this case, because their income is slightly higher, above $70,000, they're not eligible for either of those programs, either DEED, small cities, or USDA RD, Section 504. There are a couple proposed programs here on the screen, a secured fix-up loan and an impact fund deferred loan. We'll get into how that might work on the next slide here. So given the energy conservation needs in their home, they are eligible for a secured fix-up loan, but there's a special incentive. There's an energy incentive interest rate of 4.99%. That secured loan has a term of 20 years. They're also able to combine the energy incentive fix-up loan with a small impact fund deferred loan to address the balance of their project needs. Competitive impact fund deferred loans are available to fill special gaps that exist in your community. In this case, they chose to do a slightly smaller fix-up loan so that their monthly payments would be more affordable. And again, that was due to the fact that they have high non-housing debts. So that's sort of the special niche or barrier that would necessitate impact fund dollars in this case. That might be due to something like high student loan payments. A tweak on this scenario would be if we had a low-income family under 50% of the area median income. That would allow them access to USDA-RD or perhaps DEED small cities funds. A local administrator in northern Minnesota that we might highlight that's using both the Fix-Up and the Impact Fund programs is the Headwaters Regional Development Commission. So now I'll hand it off to Chrissy to present the fourth scenario.
Hello again. All right, in scenario 4, we have a family in Willmar, and they have a very low income. Recently they bought a one-story home that has 2 bedrooms and a bathroom on the first floor. Since Willmar's population is 19,717, they can access the USDA Rural Development loans through their regional office to help make some accessibility improvements. Their total project costs are $15,000 and include replacing the tub, toilet, vanity, the flooring in the bathroom, along with a ramp for entrance into the home. So some of the ways that they could use their funds, they could get a USDA loan at 1% for 20 years, $7,500 to cover half of the costs. That would give them a $34 a month payment for that particular loan. They could also, if they have a community fix-up initiative in their community, they could get a loan for $7,500 with a 1% interest rate. The lending partner would contribute $1,514 to discount that rate from 5.75 to 1% to make that payment more affordable, and that payment would be $66 a month for the fix-up loan. So for the first 10 years, this family would have a $100 payment. After the fix-up loan is paid, after 10 years, it would drop down to $34 per month, which would just be the remaining balance on the rural development loan. In the central west central Minnesota, we have the Hutchinson HRA that uses the community fix-up loan, and in the Twin Cities, we have Greater Metropolitan Housing Corporation, who does loans in multiple West Metro suburbs. So the St. Paul Credit Initiative is set up like a community fix-up initiative. The City of St. Paul wanted to target underwater homeowners who couldn't get a secured fix-up loan because they lacked equity, but they also couldn't qualify for a regular unsecured loan program due to their credit score being under the required 680. The city provided funds to set up a loan loss reserve, and we reduced the credit score requirement to 620. For unsecured loans done within this initiative. This is a great example of a partnership done on a large scale. It targeted a specific geographic area, which was the City of St. Paul. The city partnered with 6 fix-up lenders to address a community need. All right, so just to reiterate that these solutions or combinations of programs represent only one way to address the issue. There are many others as well. And this was intended to be a very broad overview of a lot of programs and not so much be a technical training, but to just highlight the different ways that these programs could be used together. On the screen right now, you'll see all of our contact information for the people that were on the conference call or on the webinar today. And we will take your questions now. So we'll give you just a couple minutes to go ahead and type questions into the chat box on your screen. And we will reply to them. We'll read the questions out and reply to them. If you have one that's very specific to one particular scenario, we may not address it here. We may just have the representative from the agency contact you directly to get you specific information. Okay, so some of the questions that we've received. One states, when did the $300 GMHF administrator fee come into play? We have an open award and have not been allowed to take an administrator fee in the past. So Robin indicates that the GMH fee went into effect a few years ago. If you have specific questions about that, you could contact her. So please give examples of agencies who would administer competitive RFP funds. And then we asked, which region, city, county are you in? And I will actually, I will let Luis answer that one.
So we're still asking that question internally. The answer was which city, regional, region, counties was that person in for in terms of the competitive RFP programs. The answer was Douglas, Otter Tail, Grant, Wilkin, Traverse, Stevens, Todd, Wadena counties, served by RD and Alexandria. And we have, the Impact Fund has a small award for affordability gap assistance to the Alexandria HRA for a subdivision up there. That's the only one that I'm directly aware of. I thought that there may be some other competitive awards. So Greater Minnesota Housing Fund does not currently have an award in that area. And Jeremy says that in Stevens County there is a Small Cities Award. Let's see. There's a couple of questions that came in for Section 504. Jenny, do you want to take those just because I'm not sure I know how to answer them?
Okay, we did get a couple of questions, and I apologize I didn't cover these. The question was, please explain credit for the 504 in good standing. Please define. So really, the credit analysis is done at the local office. If the applicant's credit score is below 640, a full credit analysis is needed. And then the other question is, which of these programs can be used with manufactured homes not on a permanent foundation? Unfortunately, our program does require the manufactured home to be on a permanent foundation or brought onto a permanent foundation with loan funds. The homeowner also needs to own the land that the home sits on. The last question is there a loan-to-value requirement on the Section 504 loan in excess of $7,500 for the grant portion? Is there, and if the loan is required to remain in the home for so many years, can the grant be forgiven? The first part of that question, the outstanding indebtedness against the property cannot exceed the value of the home. An appraisal is needed when the loan exceeds $7,500 and the outstanding indebtedness exceeds $15,000. Otherwise, we will typically use the assessed value of the home. The second part of that home, the homeowner does need to remain in the home for 3 years after the grant is approved, and at that point the grant is forgiven after that 3 years. So that is the end of my questions.
Great. And as it relates to the question about manufactured housing, which programs can be used with manufactured homes that are not on permanent foundations? So typically, the Impact Fund, when we've done owner-occupied rehab awards with manufactured housing communities, they've been related to homes that are on permanent foundations or that are real estate. We've also funded, separate from sort of this conversation, replacement units, new manufactured home units in a cooperatively owned park. Those are typically the most common examples of that. Did you want to say something?
Also for, hi, this is Chrissy again, the manufactured homes on a lot or land that they don't own, the rehab loan program, which we did not talk about today, and the emergency loan program, which we also did not talk about today, do allow for those types of properties. So if you want more details on those programs, my contact information is listed here. You could email me directly. All right, so one of the next questions, in general, what are the administrative fees that can be gained in total from each scenario? I think it might be easiest if it's going to be specific to each program, and I think maybe we could just add that to the Excel spreadsheet that we had made. So
I think we actually so we recently created a matrix of all of these programs, and it's slightly more detailed. So we will make that available as an attachment on the website. I believe there is a line on there that has all of the admin fees side by side.
okay, who is the contact for the St. Paul Initiative program? That would be me, Christy Hoffman. So if you want more information on that, feel free to give me a call or send me an email. Will the PowerPoint presentation be available after the webinar? Yeah, I believe we can email that to you, and we are recording the presentation and putting it on the website as well. How long does it take from referral to the USDA RD 504 program to actual approval and ability to start construction? Asking to determine how it would work in conjunction with small cities.
And that answer is, it kind of can vary from case to case and how long it takes to receive bids. From approval to final construction or start of the work, like I said, it really does depend on how quickly we can get bids. Otherwise, it is a pretty quick turnaround, I would say.
All right. Is there a Small Cities Award for the Sherburne County area, Elk River, Zimmerman cities? Not currently, no, there is not one. Does a community have a more competitive advantage if it has completed a housing study prior to applying for funding from agencies? Yes, says Luis. Any other comments from the peanut gallery back here? You can add to that, yes.
So I think this is probably a central, you may know, some of you may know, we try to do these periodic regional housing and community dialogues. And I think that is a central message of a lot of those conversations that, and when I say we, that's Minnesota Housing, Greater Minnesota Housing Fund, USDA-RD, and DEED, I believe, participates. We often talk about the importance of doing a local housing study, really get a handle on what your needs are, prioritize. That can be very helpful when you are putting together a competitive RFP application. We want to know that you've done your homework to really understand what those needs are and to be able to characterize that community need.
And this is Robin from Greater Minnesota Housing Fund. I would just add that both Greater Minnesota Housing Fund and Minnesota Housing Partnership, who also provide technical assistance in Greater Minnesota, both of our organizations are available for sort of consulting and TA, and either GMHF or MHP are sometimes able to step in and help with the marketing study plans. So feel free to contact me here, and if you would like to be put in touch with Minnesota Housing Partnership, we can also provide you any information on that. Another question's come in. Does the Minnesota Green Communities criteria apply to all of these programs? There may be some differences in, I'm looking around the room really quickly. Actually, through the Impact Fund, Greater Minnesota Housing Fund requires the Green Communities criteria for applications to the Impact Fund, but for pipeline applications from the rest of the entities in the room, USDA, DEED, and Minnesota Housing, Green Communities does not apply. I'm going to pass it over to Louise for a little more clarification.
So that's a complicated question, and here's a complicated answer. Green communities are not required for owner-occupied rehab programs under the Impact Fund, but it is required for new construction or acquisition rehab resale proposals under the Impact Fund. So the main distinction there is if you're proposing an owner-occupied rehab program, there aren't green communities requirements with that. However, do we like to see energy efficiency, basic necessary improvements as it relates to green communities? That's always something, you know, I think we encourage. But again, it's not required for those programs.
All right, it looks like that is the end of our questions. We still have our contact information here on the screen, and if you have any questions for any of the presenters today, please feel free to call any of us or send us an email. We will be happy to help you out with whatever situation you have come up. And thank you all for taking the time this afternoon to join us on this webinar. The webinar has been recorded. We will put that onto our website, and the PowerPoint and attachments will be sent out to all attendees on the call. Thank you.